that, I'd like to now invite our next guest, Vinay Sharma, the fund manager at Nippon India Mutual Fund, who is now joining us live on today's show to talk more about the banking sector at large. Good morning. Thank you for being live with us. I'm going to begin with the macros, and later on, I want to start with a big trigger for the stock that has come in today. I'm talking about HDFC Bank as well as HDFC Limited. Now, if one sees HDFC historically, what fantastic returns, but negligible if you look at the last couple of years. Now it seems to be a lot more about ICICI, SBI, which has been doing phenomenally well as well. But with the merger, proposed merger, decks being cleared one after the other, 2 days, two big news points that have come in. Time for this counter to finally perform, for investors to get back the returns they've been used to historically?
Well, we can't talk about individual companies, but what we would like to say is, if you look at, as your previous speaker said, that the large brunt of foreign selling has been borne by two sectors, which is financial services and IT. And especially because of the over ownership of the large counters in financial services, they have taken a majority of the FII selling pressure over the past couple of quarters, or probably a year and more. So therefore, one of the important triggers for some of these large financial counters to perform would be the reversal of FII flows. And as and when overall macros improves, not just of India, but we think of emerging markets and US yields, which have now corrected a little bit, and USD index, which has been doing so well over past few quarters. When some of that reverses, we believe FII flows will again reverse back, because India remains attractive. As your previous speaker said, there are very few sort of emerging economies which are in such good fundamentals from medium term and long term perspective as India is. And so when that reverses, we believe some of these large financial counters would start performing. That's all actually I can say on this topic.
Good morning. Nikunj also joining in. When I'm looking at the credit offtake data, and the credit offtake data now seems to be picking up, and I wonder why that is happening. Is it because of higher working capital requirement, because inflation has gone higher, or this is the cycle which we've been waiting for, that a new capex has started?
So Nikunj, there are several reasons for it. Difficult to pinpoint what is the exact reason for credit pickup. One easy optical reason is obviously that base effect. Last year at this point of time, offtake was very poor, so optically now it's looked much better. But having said that, we have been sanguine on credit growth for quite some time, and it looks like a lot of pieces of the puzzle are now falling into place. For example, inflation obviously benefits credit growth to a certain extent because working capital requirements goes higher. Similarly, retail credit in India has always been growing in mid-teens plus minus here and there, depending on the subsectors we are talking about. And retail credit now, it seems to has come in full force, and the COVID effect is behind us. Some of the smaller industries and SME, MSME, they took the brunt of GST demonetization from 2017-18 onwards. We think that effect is also behind us, and now they are also back to their normal self. And large industries are showing signs of pickup after a long time. We think India was the Indian large corporates were in a deleveraging phase from practically 2015 onwards. And 2015 to 20 was this great deleveraging that happened in Indian large corporate sector. There are signs that that phase is now behind us, and green shoots for private capex are emerging, and the large corporates have started to conceptualize projects, maybe started working on some of them. And therefore, it's a mix of all of these that is leading to credit growth. But we believe this might just be starting. Credit cycles generally go for multi-years, and therefore this could be beginning of a multi-year cycle.
So what is the best way to maximize, assuming that the points which you've just flagged off, they all come true? should one just stick to private banks, two, three large banks? I won't use the word private bank because private means I'm not talking about SBI. Should one just stick to four of the largest banks in India and keep it safe and simple because they have size, scale, capital, balance sheet, talent, and also technology?
So I would agree with you, Nikunj. And for most part of last few years, that's what we have been saying, that you should stick to large banks, both private and public. And the reasons were, as you said, they have easy access to capital. Markets are always there to support them. They have the wherewithal to invest in technology, and they have been investing quite a lot over the last few years. And a lot of these large private banks are not really banks, they are financial conglomerates. So maybe 50-60% of their valuations come from banking entities, but the rest, depending on each entity, comes from insurance, asset management, general insurance, all of that. And therefore, they were a good, diversified, slightly lesser risk way to play the financial sector. But now we are beginning to believe that maybe it's time to take a little bit more risk, and therefore, and valuations in the small and mid cap space is now very attractive. Some of these banks, as your previous speaker said, are available at less than book today. And credit cycle is just starting to pick up, and as you know, rising tide lifts all the boats. So therefore, maybe it's time to add a little bit more risk, and we are getting more bullish on some of the smaller private banks as well as some of the medium-sized public sector banks, along with some of niche plays in NBFC sector as well. So it has become a very difficult choice now. Unlike what it was in the past few years, it has become a difficult choice now because the para-banking sectors have also corrected. Insurance has corrected a lot. Some of the capital market players have also corrected. And as I said, the small and mid-cap banks from a cycle perspective are starting to look good. The next 3-4 years could be good from a cycle perspective. So it is a more difficult choice now. Large banks still remains a bigger part of the portfolio because of their market caps and liquidity and all those sort of criteria. But financial services from a space perspective now looks much better than what it was 2-3 years back, and the way to play it has become much more diversified than again what it was a few years back.
Where does NBFC come in? Because they've lost market share. They do have a large issue in terms of where the fintech and the plans have moved. What happens to the entire NBFC space, which in a sense was sold on the premise that India will need more credit and India can have not one, not two, but at least 1,000 NBFCs?
Nikunj, we have frankly never believed in this proposition. We have always been a believer of that NBFCs need to have a niche business model, and as long as that niche moat is strong, those are the NBFCs we tend to look at. So therefore, if you look at spaces like housing finance, gold finance, SME credit, affordable housing, in some of these subsectors, NBFCs do have a very big role to play, because these are some of these sectors banks really don't cater to. And India being such a large country, there is always space for more, as you said. So we tend to be selective in NBFCs. That approach continues. Along with that, now a rising interest rate cycle, where the cost of funds generally tend to go up a lot more for NBFCs than with large banks, because banks have that cushion of CASA with them. That makes, generally in a rising interest rate cycle, that makes banks quite more dependable from a risk perspective than NBFCs. So therefore, our answer to that would be, we tend to be selective in NBFCs. We continue to be selective in NBFCs. Having said that, there are some spaces which look quite attractive, either due to valuation or because the longer term growth could be higher than general credit in those subsectors. And we tend to invest in some of those NBFCs. But from an overall perspective, in a rising rate scenario, we believe banks are probably positioned better than NBFCs.
Okay, Vinay, great to have you on the show. Thank you so much for taking the time out and speaking with us today.
My pleasure. Thank you.